morning, all. Thanks for attending the session today. And the whole idea of today's session that how to build a regular income from a retirement perspective. It is more about getting a financial freedom than looking at thinking that post retirement to build an income. Because in today's time perspective, I think one thing which we have seen has changed significantly, that we cannot think retirement age as a 60 or 55 and plan accordingly. So today the whole planning is that to build a good corpus which can help us to have a mental peace, which can later stage help us to take or financial freedom or take a retirement whenever we wants to do it. So that's the most important part. So when we are doing a planning, we should not look at that, okay, everything will go fine and we'll retire at 60 and things will be done in that way. That's a first foremost part. Second thing, I think what we have seen in last 5 years, that markets have given very good returns. So most of us think that, okay, because last 5 years we made 15% type of a 15 to 20% type of a return. If things continue in the same way, then everything is achievable without any sort of worry. But fact is, if you look at past is not going to be the future, and if you look at the way things are changing, especially if you look at the debt returns, which were earlier 8 to 9%, now it has come down to 6% around. Same way, if you look at gold and silver, they are at a peak. Equity markets also run up. So technically, the future returns cannot be as high as it was 15 to 20%. Now it will be between 10 to 12% to 12 to 15% range. So one thing which we have to, when we are doing a planning, we have to look at that. Keep worst case scenario in mind. Don't plan that, okay, I have achieved in last 5 years. This is the same way it will continue. It doesn't work in real life because factors change. Now, I'll move it to the overall agenda of this, how to build a regular income post retirement perspective, how we can enhance the wealth, and what are the best options. So, at a right horizons, we have a proper structure retirement planning process. So, first thing, somebody needs to understand what is the corpus based on his retirement goals required. So, typically, what we suggest that whatever your current monthly expense. So, somebody if is spending monthly a 1 lakh, technically post retirement also expense will remain the same. The only thing which get changed is that instead of maybe EMI and kids education expense, you may have a health perspective expense or a travel. So that's also the myth. Normally, people think that post retirement I will have a lower expense because I don't have a EMI or I'm not paying for the education fees. But in real life, it doesn't work when we are doing a planning perspective, because there could be a need, and we have seen, for example, today it becoming very common where some people having a caretaker at home because of the health situation, and today even for a small health checkup itself will cost some 15 to 20K. So secondly, whenever somebody is planning a travel, if in India it maybe cost 2 lakh, if planning on a global travel it will cost 5 lakh. So our thing is that we may think that our expense will reduce, but technically it will not reduce. And the whole reason why we are doing a planning, that we can enjoy the same lifestyle, or we can do things as per our aspiration. We should not limit ourselves. So the whole planning is not to make that you don't do what you don't want to do. So first we assess the overall retirement goal. Then we look at your current financial positions. Then we look at, okay, what are the different retirement income sources can be built up. So which can include existing, for example, somebody have a real estate. It could be a rental income from every interest. Then we look at what are the risks. Then based on that, we come back how we should look at and diversify the portfolio, and we manage complete end to end the retirement portfolio, and on a regular basis we monitor and do the required changes. So what are the different investment option? If we look at, I think If you look at bonds, mutual funds, trials, pension plans, and insurance side, you have a annuity, NPS, guaranteed plan. But one thing, at least I can tell you, there is no option. I can say that one option can fulfill your whole requirement, because each option have their own pros and cons. To give an example, I think the one of the most used option which normally people use, think that okay, as a part of job I am having my PF. So, but if you look at one of the drawback of the PF is that at the retirement you will get as a lump sum money, but post retirement you need regular income. So the whole objective of retirement as a PF will not fulfill. And secondly, from PF, if you look at, you will not be able to build a corpus which is sufficient enough to take care of your whole thing. Third most important part, because when after 10 years or a 5 years somebody is getting a PF corpus, that point of a time rate of interest will be very low. So if he plan that time to put in any fixed instrument, his income is going to be very low. And secondly, he has to look at from a tax angle also. So any instrument today, if you look at on a post-tax basis, if it's giving a below inflation return, then it is not going to add any value on a overall growth perspective. So PF, we think that it will take care for retirement, but will not take care. Then second instrument, normally what normally most of the investors look at that NPS, because NPS is a good instrument in terms of giving a growth, because it have a mix of debt and equity. So it is good from a corpus building perspective. It helps to save the tax during working time. But the biggest drawback of NPS is you cannot withdraw part of fully before retirement, and only 60% of the corpus can be taken out during retirement. So the balance 40% you have to take the annuity, and annuity rates will be decided that point of a time, and the annuity is taxable. So if you look at post retirement perspective, NPS also doesn't add much value, because if you look at annuity rates are today itself is around 6%, and after 5 10 years it may be become 4%, 5%, and that too it's a taxable. So technically, even you have built a good corpus, but you are not able to have a good source of income through NPS. PPF, I think the biggest drawback today, if you look at government recent years, they are not increasing the rate of interest, and PPF also give a lump sum money, so it doesn't help to build a regular income. The fourth option, senior citizen savings scheme, I think that's one of the best option on a fixed income perspective. So normally we suggest someone who is retired what to look at as a first step. I think it could be a good option, but it could be a part of the option, because there also your principal locked in and you get a quarterly interest. In maximum you can do up to 30 lakh of allocation. And if you look at, you have a time period issue also, because maximum either you can do for 5 years, and 3 years you can do extend. So it cannot take care of your full life term in terms of the requirement perspective. And the interest is not monthly, it's a quarterly payment, but still it's one of the good option to look at. And apart from that, I think so. The whole idea of this to explain is that we have to look at on a combination approach. So another option, we look at the pension plans, which can give the guaranteed tax-free income post-retirement perspective. It makes a lot of sense for someone who's looking at fixed income product with tax-free. So one thing we always suggest that look at the tax angle and liquidity also, apart from the risk. So normally these are the three parameters apart from returns what we look at. Return, then risk, and what is the post-tax return, and what is the liquidity, because that become very critical. And another myth normally people have, that retirement means I have to move everything on a debt, and I have to manage my investment. So in our view, we always believe that post retirement perspective, you have to look at based on we have to create a different buckets. So normally what we suggest, the next 3 year of expense we typically keep it on a pure debt. because then 3 to next 5 years we can have a hybrid allocation. Money which we need after 8 years, we can look at equity instrument. So that thought process is not a right that if I'm getting retired, I have to just look at the safety. So risk is always associated with the time. So any instrument, if you look at on the equity and hybrid side, has done very well if somebody has given a time, but it need a time of 3 to 5 years to see the real impact coming up on your portfolio. So we always suggest that don't just buy some products and think that my retirement is taken care. It has to be done as per the bucket strategy, where based on your requirement at a different point of a time, you have to put a money. For a short term need, you should not put money in equity and hybrid. It has to be in a pure debt. For a medium term, we can look at hybrid options, and for a longer term, we can look at equity. So I think that is the way. But normally people do other way around. For short term, they do a lot of equity. For long term, they keep it money into a fixed instruments. So that is the one of the reason why people are not able to create a wealth, because that is the most important. And secondly, as time goes, we have to look at how we do a rebalancing of debt to equity allocation. So typically, if you look at this is the way we look at on overall perspective how the debt to equity allocation be decided based on the risk profile, because risk profile also is the most critical part as a part of the allocation perspective, because everybody look at investments in a different way. So somebody who at a 50 to 60, there could be a mix of equity, hybrid, and debt, and all these things are from a retirement perspective once he is looking at to retire. So the allocations are decided based on their age or income, their risk profile, and what is the corpus they have built up. So we do a customized retirement planning because we believe everybody have a different investment, same way they have to look at do it. The most important part is that it should take care of the long term needs, and we should not look at that we are going to have very high returns. So when we are doing the retirement planning, typically our view is that post tax we should look at 8% type of a return post retirement. Even we are getting higher return because these are our bonus or a backup for future and any sort of uncertainty. And we should look at that we have taken care of proper nomination or a planning for a next generation, having a will creation and other thing, because these things become very critical. And one of the most important thing, to have a very good health cover, because many a times we ignore that part and we end up taking money from our portfolio. So we always believe that before planning for investment, at least from a retirement perspective, somebody should have at least a good health cover, which is could be a mix of base plus super topper policy, which could be 50 lakh to 1 crore, because it is very critical in today's time. And these are the instrument on a tax saving perspective, which somebody can look at on lower risk perspective. And we have given the different scenario, what are the options, how we can look at in a combination. So if you look at on equity side, equity mutual fund, hybrid funds, or we can have a equity share and ETF typically, which can give 12 to 15% return. Then we have a fixed income instrument which can give 7 to 8% return. Then debt funds today, pure debt funds not adding much value. So either arbitrage or income arbitrage type of option. Tax free bonds today only we can buy through a listed market, not available. And last option are the retirement income plans, which can give guaranteed income post retirement perspective. Now we will come to the main part, how to build 2 lakh of a monthly income and what is the corpus which is required. So if somebody is looking at, for example, so we have done the different scenario. If somebody need a corpus for 30 years, so technically 30 years means somebody is retiring at 55, and if we keep life expectancy till 85, so 30 years of a corpus, if somebody is looking at to build with 8% return scenario, So in that case, monthly income perspective, he need 5.2 crore of a corpus. If it's retiring at 55. So same way, if returns, for example, if you look at for the 40 years, somebody needs to plan for the corpus, then 6 crore of a corpus, which is required, 6.3 crore of a corpus, which is needed from a post-retirement perspective. So the whole idea of giving the different scenario is that what is the overall corpus required, and the reason why we said 2 lakh of a monthly expense, because if somebody having a monthly expense today of a 1 lakh, so after 10 years post inflation, if you look at the expense are going to become 2 lakh a month. So idea is that at least to build a corpus which can take care of expense which is sufficient enough. So if you look at somebody have a 3 lakh of a monthly expense today, then in that case 7.7 and 9.5. These are the different scenarios. So average, we believe that from a retirement perspective, somebody should look at and plan that at least to build 5 crore of a corpus on an average, so that at least he'll be able to take care of his expense. The reason why we have looked at 8% return scenario, because first thing, on a post retirement perspective, we cannot have very high equity allocation. Second thing, today the tax is taking major part of the gain also. So technically, if you look at almost 1 to 2% of the gain, irrespective of what option you choose, will go as a part of tax, because equity also today is a taxable, which was not their earlier case. So we have to look at not just the return part, we have to look at the tax angle also as a part of the planning. Tara, can we have a poll now?
Yes, sir.
So the next part, how to build. So that's the reason we have kept a poll to make you understand that how we can able to build this type of a corpus. Yeah, yeah. Maybe we can end the poll. Can we show the answers? Means
Okay,
the
I'll share this.
yeah.
Yes, sir, I have shared.
Yeah. So if you look at the right answer is 2 crore of a corpus, which will get built up. But the reason why we have kept this question, so if you look at 15,000 of a SIP, somebody is doing it for 15 years, it will create 1 crore of a corpus. But just additional 5 years will give the corpus building of 2 crore. So, which means many times we think that long-term investing may not able to create a bigger wealth, but the real challenge is if we know what is the time frame of the investments that we have to do. So, the same instrument in a 15 years will create a 1 crore, and 20 years it will create a 2 crore, because your base become larger. So we always say that when you are doing retirement planning, it is not that the amount of investment what we are doing, because most of the time people always have a thing that today I don't have more of a saving, i'll plan I'll plan my investments later, so they delay their investment process. So we always seen that it is not that amount of money what is required. The most important part is the time what you give to the investment. So what we have seen, to see the real impact of any investments, you have to give a 20 year of a time. So same thing in 15 years, creating a 1 crore of a corpus. If you just add another 5 years, it is creating a 2 crore of a corpus. So what we believe that people who are at an early stage of their career or mid part, when they are planning for investments towards equity, one thing which we have seen can work, do investment and forget. So we have seen many of our clients, they never take out money from their investments, and they have the one who has really created a big wealth. So the biggest wealth creation not happen that you have a best fund or you are taking a high risk. It is more about the time. So the real wealth is always linked with the time, and you have to start early, even you're starting with a small amount. So even a 15,000, a small SIP can build 2 crore of a corpus in 20 years. So that is the one big thing which we have to look at. So sometimes even to build 6 to 10 crore of a corpus, it is not a big thing. The big thing is when you are starting and what is the time you are giving, because most of the time we stop the power of compounding, we try to time the market, we stop SIP in between, or we take out part of the money. So we always say do investment as per the goals, and those investment don't touch. So if it's any money which you're investing for retirement, give 20 years of a time, because that's how you have given a time to other investments. So when you invest in real estate or invest in gold, you don't touch for multi years or even one generation to other. But same thing if you do with the equity, then you will see the real impact coming up on the investments. And to give another example, SDFC FlexiCap Fund, which have a 30-year of a history of the investment, you will be surprised to know if somebody has started 5,000 of a SIP in SDFC FlexiCap Fund. If you look at in last 30 years, the corpus what as a fund has delivered is 10 crore in 30 years on 5,000 of SIP. And what will be the actual investment of the investors? It is only 18 lakh. So only 18 lakh of an investment can build 10 crore of a corpus in 30 years. So that is the power of compounding and the thing. So even funds which are not high risk also can give you phenomenal return. So the only thing is you have to hold that investment from a longer term perspective. Second scenario we looked at on 7% inflation and 10% return scenario. So if you look at on a 2 lakh of a monthly expense, it is almost like a 5.4 crore for 40 years and 4.5 crore required for 30 years of a corpus.
Sir, can
Third
you please
scenario,
repeat? Your voice was not audible.
yeah, okay. Yeah, so second scenario, we look at 7% inflation and 10% return. So wherein, if you look at that corpus requirement is 5.4 crore for 40 years of a corpus. So 40 year of a corpus means if somebody is retiring, for example, at 45, looking at till 85 corpus building, because we keep life expectancy till 85. So we have looked at multiple way. So 30 years is someone, for example, retiring at 55 till 85 if he has to work. So if you have a 4.5 crore of a corpus, then 2 lakh of a monthly can be taken care. So if you look at on an average from both the example, if you look at average is 5 crore of a corpus. So what we suggest for all our investors that retirement perspective always think that at least you have to build 5 crore of a corpus so that it can take care of a retirement. This is a scenario where if somebody not plan well, then you can look at how the corpus requirement increase significantly, because that's a one area where we have seen most of the investors where post tax their returns are hardly 6%. So if your return is 6%, then you look at your corpus requirement for 30 years become 6.8 and 9.1. So it's a big difference here. You can see earlier it was 5.4 and now it is 9.1. So just 2 to 3% of a return difference can create a huge impact in terms of the corpus what somebody need from a overall perspective. And the next part is financial freedom corpus. So most of the people who are at a young age, they want to retire, want to build a corpus for next 50 years. So somebody who is at their 35, 30, or even at a 40 want to build corpus. For that, I think the best scenario is if you look at if he's able to build 7 crore of a corpus, then easily even at 30 also somebody can retire. So many times we think that for retirement you have to have lot of time you have to work, but if you plan well, even you can start early. So this give one kick that if somebody wants to achieve financial freedom at early stage, he can do, provided he build a good corpus, and don't keep more than 10% as a return scenario, because that is practically in a long term is not sustainable, what we have seen in last to 5 to 10 years. Because many of you think that we are showing very low return, but fact is as time goes, as economy become developed, your returns will come down on all the asset class. So what we have seen in the past are not going to be the future returns. So why you need a high corpus? I think longevity, one of the thing, because today average life expectancy has increased. We have individual families, so there is no support system at what we used to be have at the joint family level. No pension income. The way government employees have a pension income, there is no pension income. And the way technology level things are changing, so even you are till when you are planning, you think okay, I'll work till 55, 60 or 50, but because of the technology changes, you don't know even next year the job will be certain or not. So we have to plan very aggressively at an early stage. Then the global family concept, where kids are studying in abroad, settling abroad, so a lot of expense which are going for travel, even if people are planning to settle in abroad, because if the same person who is spending in India 1 lakh, he has to spend monthly at 3 lakh if you settle abroad. So there is a lot of difference which will come in terms of the corpus. And the last part, I think many times people do a mistake. So we always believe when if you are doing a mistakes in the investment planning, do it at an early stage of a career. Don't do at a later part of the career. That's one of the reasons where the advisors help make a lot of importance, because at a later part of a career, if you do a mistakes, then you cannot rectify, because then you will not have much of time to build the corpus. So the one thing which we believe that I think it is not the amount as we told. So even somebody start age of 25, even at a 15,000 of a SIP, he can build a 10 crore of a corpus at till 60. So it is not that you need a lot of money. It is only the time factors. And if we add corpus, if somebody already, so we have done the scenario that okay, somebody have already corpus, if we do additional SIP, how it can help to build the corpus. So I think the first step is systematic investment plan, invest regularly and try to build. So even 1 lakh of a monthly investment at a 12% return, it can build 20 crore of a corpus in 20 years. So that way, it is not a rocket science for someone to build. It's only thing you have to give a 20 year of a time to build. Second is do a setup, do a top up SIP, increase the SIP, and do a portfolio diversification, which means have a mix of equity, debt, and alternatives, which includes gold, REITs, and other things on the overall perspective. And whenever you have excess savings, use for the investments or to pay off your loan. So we always suggest that as early as possible, you should reduce to have a lower liability. That's also is another thing which we should look at, and do STP way investments instead of doing it as a one-time investment. And keep realistic return expectation. Don't keep more than 12% as a return expectation, because what we have seen in past will not work. So many times higher return expectation can create a lower corpus buildup. And do a yearly review of the investment, because that also is the one thing which we say, people think that every month or every quarter I have to look at my portfolio. Actually it is not going to help you, because any investment which you do, it you need to give a time, and there is nothing called a best fund or a worst fund. It's only thing you have to go through a cycle. And normally we suggest that avoid doing individual stock investments or doing FNO and other thing. Do it, use the professional advice, either do it through mutual fund, PMS, AIF. These are the better way of managing money, because individual investment doesn't work even you are doing yourself. So as I mentioned that, okay, how we are able to build a corpus, I think in 20 years, if somebody doing 1 lakh of a SIP, can create a 10 crore of a corpus 15 years 2 lakh, 10 years 4.3 lakh. So many times, even if you're doing a small, but the most important part is the time. So if somebody give 31 year of a time, 25,000 of SIP also can create a good corpus on the retirement perspective. So what should be the asset allocation strategy? I think it should be a mix of all the assets. And I think that is the most important part because that helps to reduce the downside risk. Because many times people think that if I just keep 100% equity and I'll be able to generate more return, but practically it doesn't work that way because the market volatility will take away the major part of the return. So if you look at the ideal allocation, if you look at 70, 15, 15, which is able to deliver 13 to 15% type of a return. So fair mix of in the overall asset, and we can add the global allocation also based on the availability of the options. The next way is that how to take care of the regular income post retirement. So we call SWP, which means systematic withdrawal plan. So I have given one example that how SWP help. So somebody if is invested into SDFC balance advantage fund 10 lakh at 94, even if he's taking out 7,500 every month from a 10 lakh of investment. So if you look at still his corpus would have grown to 8.57 crore even after taking out the money. So SWP is a very good option from a long-term wealth creation perspective, and it is more tax efficient also because when you are taking out money, you are not just taking out money as an interest, you are taking out principal plus interest. So it is more tax efficient, and the tax implication is lower side. Only thing, you should not put everything into one particular scheme, and you should not start at a day one. So we always believe that first you build the corpus, then start taking out the money. And second thing, we suggest the dynamic fund. So I've given an example of ICICI Balance Advantage Fund. How, as a fund level, able to do a debt to equity allocation change, which helps to create a return. So many times we think that to create a good return, we need to invest only into the equity. So hybrid work a very good instrument. So if you look at last 15 year of a return, even with average 50% equity allocation, ICICI Balance Advantage is able to give 12.5% return, where Nifty has given 11.98% return. So hybrid funds are very good way to build retirement corpus, and we can use for SWP perspective in a long term perspective. And if you look at the returns, how many times it has given lower or negative return, it is on a very lower side. And how STP way it can, so if you look at it is able to deliver almost 12% return post tax as a thing. So a tax, if you look at normally 1% of amount go as a part of the tax, but even post tax, if you look at overall XLR comes around 12%, which is very good, the level of risk as a fund it takes. The next, which we suggest, the multi-asset approach, wherein we suggest not just to look at equity and debt, adding gold, preferential REITs, invest preferential shares. So there also we have given one of the fund example of ICICI multi-asset, how it is able to deliver the returns which are better than a Nifty itself. So if you look at 5 years of a return is 25%, where index is given 18%. Last 3 years return 18%, where index is given 13%, with average 50% equity allocation. So these are the type of funds which can be helpful to build corpus post retirement perspective to get the regular income. And next part is that have a good mix of large, mid, and small cap. Many times people think that mid and small cap is risky, but they make a lot of sense when you are buying at early stage, when their valuations are not expensive, and they really create a big wealth in a longer term of the cycle. So only thing, the timing make a lot of difference. So we have given some of the examples how we can build. So on a different funds level, so multi cap, flexi cap, mid and small cap combination, index one and ETF, then direct equity normally we don't suggest, but if somebody have experience then only. Otherwise, fair mix of fund can help to help uh, good portfolio creation. Gold also is a good instrument to look at and build a corpus, but we have to understand that gold also go through a cycles where it does not deliver return. So it's always makes sense use as a combination approach. Don't just think that what gold has delivered in past will be able to deliver. So as a part of the portfolio, we suggest 10% of the portfolio can be in a gold and a long term. One of the thing which we are giving example that how your allocations make a difference. So you can see here on a fund level, if you look at 20 years, if fund can create 20x of return. So average, we have given some funds example. On an average, every fund has created 20x wealth. But if you look at in 15 years, it is created only 5 to 7x. So the main thing is the time. So we today we say that if you need real wealth creation for retirement, do 20-year planning. Don't look at 5, 10, 15 years. That is where you will see the bigger difference. Otherwise, you have to do a larger corpus thing as a part of allocation. I think time is more important than timing because many times even you have not exited when any sort of a major crisis happened. But if you look at markets have recovered and done well post crisis. Second thing, if you look at fall with recovery, so if you look at majority of the time, the fall compared to the fall, the recoveries are very strong. So if you look at last 10 years or 15, 20 years, so this is the chart of the fall and the recovery. So even you think, okay, my investments have come down, but one thing which you have to keep a faith that when recovery comes, the recovery will be much more stronger and better. So if you look at in 2008 to 10, because that's a worst scenario where markets have come down by 51% in 1 year and 2 months. But after that, if you look at in 1 year and 8 months, it has moved up by 157%. So many people who think that I am not able to time the market, it is fine because even if you stay invested, you create bigger wealth than people who are able to time because always what we have seen that the recoveries are very stronger at least last 20 years we have seen, and one of the reason is that liquidity is very strong in the Indian market because if you look at almost 27,000 crore of today SIP book is there. That itself shows how people are able to create a wealth. The second, always people have a issue that okay, markets are all time high, if I invest now, what is going to happen? But if you look at even based on the past data from last 25 years, even somebody invested at a all-time high, you can see their 1, 3, 5 year of a return. So you continue to create a wealth because one thing we have to understand that even markets are high, your earnings also increasing. So markets are slaves of earning. So they are not just a number. So don't think that markets moved up. And I'm investing at a wrong time. Only thing you have to look at are earnings are moving up or not. So if earnings are moving up, your returns continue to be there. Only thing there are times where you have to go through a fluctuation. Second thing, people think that I should do a profit booking and do all these things look very good theoretically, but when we look at the backup testing, even people have done the profit bookings at a multiple time, and people who are just buy and hold for the long term, they are the one who has really created a wealth because this is a one study where we have done on a different scenario and what is the wealth somebody has created, especially time like today where you have to pay every time you do a transaction you have to pay capital gain tax. So that way also it makes a lot of sense that don't unnecessarily interpret the power of compounding. Let continue to look at grow. Only thing, look at your goals. So if any goals which are going to come in next 3 years, for that you keep money in a debt. So that's the one thing which we advise to our investors. So what are the tax optimization thing? I think hybrid funds are more tax efficient, which are able to give a equity type of a yield. SWPs are better than doing a regular payout. Income arbitrage is coming up as a good option for a short-term perspective. Then looking at pure FD, if somebody is have a 2 year of view, and look at annually rebalancing and asset allocation, track it, increase your SIP as your income grow. And I think discipline is the most important. Final thoughts, I think start early and stay invested. Choose tax efficient investment option. Review and adjust yearly. Wealth is all about, I think, time, discipline into strategy. I think that's all from my side. If we have any questions, we can take it here.
Thank you, sir. And I would like to launch a feedback poll before we move on to Q&A section.
Yeah, maybe before Tara, we can have that second poll also. That one of the poll which.
Yes, sir. I'll add that.
The second question, what we keep it, if somebody give you 10 crore today and somebody tell, okay, I'll give you 1 rupee, but it will get double every day for a month, which option you will choose? I think after my session, everybody will choose right. That's what I'm thinking. So it will be a testimony of the session that we are able to educate or not. Yeah, we can end the poll.
Yes, sir.
Good.
Most
I
of
think, yeah. I think at least we can say people are able to understand that how the power of compounding work. Just to give you the thing, uh, if 1 rupee get double every day, if you look at in a 1 month, it is able to create 107 crore of corpus. That's the power of compounding. Sometimes even a small thing can make a big difference on an overall level. That's all from my side. Thank you all.